Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. China's equity market continues to face challenges, with an index of US listed Chinese shares falling 6.9% overnight as investors remain unconvinced by the latest stimulus measures. In Asia, India is set to deliver its interest rate decision, and additionally, South Korea has successfully joined the FTSE Russell's benchmark bond index. While India's debt will be added to the FTSE's emerging market bond index starting next September, with a final share of 9.35%, the second highest after China. On the rates front, market expectations have shifted dramatically in the US. Just 15 days ago, the probability of a 50 basis cut in November stood above 60%, but now that's completely off the table. Good morning, JK. With all the recent monetary policy developments, how do you see the markets reacting to India's inclusion in the FTSE index and your thoughts ahead of RBI's MPC?
Good morning, Swaraj. Yes, inclusion of Indian Government Bond Index in the EM Government Bond Index, Regional Asian Government Bond Index over 6-month period from September 25. That's a very good news. It represents about 9.35% of the index on a market value weighted basis. The good part is that India had to wait much lesser time compared to South Korea. And South Korea has been included after a waiting period of nearly 2 years. But the FTSE has actually recognized the progress made by India in their ease of investments, rules, etc., and included Indian bonds accordingly. While the amount that we can expect in this regard is still being assessed, we will inform you of that. But definitely, it's not going to be as high as JP Morgan Global Bond Index, but definitely it adds to the another lump of investment that India can expect in the coming year as well. And good thing is that it's coming just ahead of the monetary policy by RBI today, which will be announced at 10 a.m. India time. And the overwhelming expectation of analysts and market players is that both rates and stance will be kept unchanged for the ninth consecutive meeting by RBI. In my view, there are no significant developments in the conditions that would warrant a change in the policy or the stance. Inflation coming below 4% in the last two data points had a lot to do with the base effects, but that base effect is unlikely to be helpful in the coming inflation numbers. In fact, we would be looking at how the headline inflation pans out after the recent strong rise in the global crude prices in the wake of Middle East war as well. So some point to the slowdown in some of the fast on the high frequency indicators, which even RBI tracks. However, I feel these are more seasonal, and with the festival season coming up, these indexes are likely to be back to their normal levels. And India does not have a growth challenge. It does not have a low inflation rate closer to target like other developed economies. So I think RBI will be justified in keeping the rates and stance unchanged. Also, some do point out to the fact that Fed has cut rates by 0.5%, hefty 0.5%, and they're likely to cut in every meeting coming up in the near term, at least up to middle of next year. But very unlikely that this being a mid-cycle rate cut by Fed. I think India is unlikely to follow the same. In earlier instances, we have followed it only when there has been some sort of a crisis, which all the central banks had responded to with rate cuts. We are not in such a situation. Therefore, I think there's all the reason to expect an unchanged policy. However, interest will be on forward guidance, growth and inflation projections, and that is expected to be also unchanged according to me, both inflation and the growth factors. Now, of course, staying on the monetary policy and in line with many other global central banks, the Central Bank of New Zealand cut the policy rate by 0.5% today, and this is the second cut they have made, and total of 0.75 cut in the last 3 months, recognizing the fall in inflation and also to obviate the slowdown in the economy. So monetary policies are on the easing side. Good news from the Indian point of view as far as this inclusion and also the general policy rate cut that's happening everywhere else is that India yields remain on the higher side compared to the other major central banks, and that would be helpful for the rupee, maintaining its stable range, which RBI has successfully maintained for long. In fact, yesterday also we had seen outflow of nearly 1 billion from the Indian market, bringing it total outflow in the last 10 days to about 7 billion. But RBI has successfully defended the 84 level, and rupee has been, trading well below that in the offshore market, and now also indicated around 83.92. Yes, the rupee is be expected to maintain these levels with a lot of flow from India to China, which has been talked about in the market. That having happened, I think there can be a pause. In fact, Chinese markets have already shown that the recent moves is some sort of an indigestion to the investors, and yes, today's market in China has shown complete erasing of yesterday's gains, and market wants more. Market wants some desert from the Chinese authorities. They will have to wait for some more time, perhaps. But I think overall, Chinese market do remain attractive on the basis of valuations. Yes, on the global side, not much movement in the currencies. We await the monthly inflation report from US tomorrow, where most of the parameters are showing marginal drop, and that would help the rate expectations or rate cut expectations from US. But yes, it is well moderated to 0.25% from 0.5% that was expected earlier. In the absence of data, statements from the Vice Fed Chair, Mr. Williams, was important, and he said the dot plot of officials rate forecast was a very good base case, and he also said the US economy was well positioned for a soft landing, and the rate decision was right in September, and even right today also, and that the 0.5% rate cut in September was not the rule of how they were going to move in the future. So basically he's justifying what they have done, and he's also said that the rate moves going forward would be on a month-to-month basis. So all in all, I think markets are calm. There is no indications of any fresh attacks on the Middle East. So we should expect some recovery in the risk assets and also rupee to remain stable. And overall, there's no real clear direction as far as the major currencies are concerned, awaiting fresh triggers as well. Thank you.
Thank you, JK. And just quickly summarizing the FTSE Emerging Bond Global Index inclusion, India had to wait much lesser than South Korea's 2-year waiting period. So this inclusion is also coming right ahead of RBI's monetary policy, where rates and stance will be kept unchanged. That's what the markets are expecting. On the rates front, we also had New Zealand Central Bank cutting rates by 50 basis points as inflation falls and growth slows down. So one positive thing is that the Indian yields remain on the higher side as major central banks go for rate cuts. So that should keep rupee stronger as assets in India remain attractive for foreign investors. The rebalancing in portfolios to allocate more to China might also pause as Chinese government does not seem willing to act fiscally to support the economy similar to the recent monetary policy supports. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.